Extreme volatility in financial markets spooked grain prices in March. Has the Federal Reserve finally calmed down the impact of the surging dollar? All that noise from Wall Street kept traders from focusing on USDA's March 31st reports. But the latest farm futures survey brought the discussions back to acreage. Spring is officially here. What does the weather outlook hold for rallies? I'll discuss these questions and more on this edition of The Buzz. It's been a couple years since my daily comments on the grain market focused more on New York than Chicago. But a 20% move by the dollar since summer intensified this winter. In theory, investors were buying dollars because they believed the Federal Reserve would begin raising interest rates long before other central banks around the world, who are still printing money hand over fist to stimulate their economies. But there was also a lot of fear triggering the dollar surge. It's the safe haven of choice in uncertain times. As money managers bought dollars, they fled risky investments. Some days that included stocks, but most of the time it focused on commodities. Surpluses of everything from corn to crude oil and coal depressed prices, creating bearish momentum that fed on itself. Then the Fed lifted the dark cloud, or at least appeared to. Chairperson Janet Yellen detailed a slower approach to interest rates at her quarterly press conference. She voiced concerns about the impact of the dollar on growth. The forecast of those participating in the meeting lowered their projections of growth and inflation all the way through 2017. After a couple turbulent days, the dollar was weaker and markets rallied. There's a dark cloud to the Fed's silver lining, however. If economic growth stays tepid, demand for commodities, including food, may falter. My research shows there's no correlation between the dollar and U.S. crop exports. That can be seen best in the wheat market. When adjusted for currency changes, prices of futures in Paris, Chicago, Australia, and Kansas City are all down about the same. And those in Canada actually grew more expensive than Minneapolis. If the Fed-induced optimism holds, traders may finally be ready to focus on USDA's March 31st reports. Our latest Farm Futures Planning Intention Survey, completed March 16th, showed how growers are responding to this new price environment. They want to plant less corn this spring. For one, we estimate acreage at 88.3 million, down 2.5% from 2014 and 170,000 less than our January survey. Soybeans are another popular alternative, but not quite so much. We estimate soybean seedings at 87.3 million, up 4.2% from last year, but more than 1 million less than our January survey. The declining soybean to corn ratio was one reason. Growers all over want to plant more soybeans, but we found a big shift in the delta due to lower cotton seedings, which could drop 15% to 9.4 million. Farmers are looking for alternatives wherever they can find them. That includes a lot more sorghum and other crops where possible. Durum wheat should be more popular on the plains, and spring wheat acreage could be higher too. We found winter wheat seedings up a little from USDA's January survey, with total wheat acreage at 55.6 million. Once the calendar turns to April, weather will be the focus of both the market and farmers. I released results of our survey in an online webinar which included the spring forecast from meteorologist Greg Sujet. Later, I caught up with Greg at the studios of This Week in Agribusiness. Greg believes farmers in the eastern Corn Belt may have drier conditions for planting, while those to the west hit some speed bumps.
Looks like there'll be quite a disparity of timing issues into play between the far easternmost part of the Corn Belt that should have a normal pace at both corn and soybean planting versus areas into the Central Belt, mid-Mississippi Valley, and actually westward into Nebraska, parts of, if not much of Iowa, southern Minnesota, northern Missouri, where there may be significant field work and planting delays because of recurring wet weather a good part of this springtime season.
But growers across the region may face challenges, creating opportunities for spring rallies.
Exactly, much like the past 2 or 3 years over parts of the complex. I think there'll be a challenging planting season ahead, especially those central Corn Belt areas back into the Great Plains. A little better opportunity, but we'll be fighting cool and cold soils for germination into the far eastern areas, Michigan, far eastern Indiana, and Ohio. So yeah, the market will be reacting on an almost daily basis as we get into the core of springtime and the planting season across the Plains and Corn Belt.
While summer's a long ways off, Greg sees potential for more concerns to surface during the heart of the growing season.
I don't see a severe drought pattern. Matter of fact, we're going to be looking at significant drought improvement that could even take into account some of those core summer months into Nebraska and Kansas and Oklahoma. I think there's a propensity for better organization to the dryness and moderate drought, perhaps local severe drought, that will quickly materialize. It'll be a quick shut off to those rains into Wisconsin, northern and eastern Wisconsin, more so Michigan, more so into Indiana and Ohio. Those eastern areas that should have timely rains, windows of opportunity could quickly go into a drier scenario. We'll be clamoring when and where is the next rain in those far eastern belt areas as we advance through the summertime season.
All in all, it sounds like it should be an interesting spring and summer for the markets. Well, that's all for this time. I'll be back after the March 31st USDA reports with another edition of The Buzz.
We'll have to have more margin now, there isn't any doubt. So you better dash with a load of cash, or we'll have